Welcome to the deep dive. If you've ever looked at your investment returns and sort of felt like Uncle Sam got the biggest slice, well, you know taxes aren't just annoying.
Right. They're often, structurally, the single most expensive piece of the puzzle for investors. It's huge.
Yeah, exactly. So today we're grabbing a stack of sources, really digging into maybe the biggest overlooked secret in finance.
Which is?
That real estate investing, well, it comes with this whole suite of tax benefits that honestly few other investments can even touch.
That's spot on. It's not just about building wealth, it's about actually keeping it.
Right. So the mission today, for you listening, is really to give you a shortcut.
Yeah, a clear path to understanding why the way real estate is taxed fundamentally changes your net return. People focus on yield, appreciation, fine.
But the tax part.
But the tax part, that's often where the biggest wins or losses really happen. It's all in the planning.
Okay, let's unpack that then. If I'm comparing options, why is the tax code seemingly so, I don't know, enthusiastic about a rental property compared to, say, a hot stock fund?
Or bonds, yeah.
What's the fundamental difference in how the government treats that income?
It's, well, it's profound, really. And it starts with the structure, the intention behind the code.
Intention?
Yeah, the tax code is basically designed to encourage certain things, right? Like asset acquisition, building things, providing housing.
Okay, incentivizing behavior.
Exactly. And that translates into these massive deductions you just don't find elsewhere. We're not talking about like minor write-offs. We're talking about a situation where the law actually helps you generate significant cash flow, but on paper, you might show the IRS a loss.
Okay, that sounds a bit like magic. Financial alchemy, maybe?
Well, it feels like it sometimes.
So how is that trick done? Let's start with the big one, the cornerstone you mentioned. Depreciation.
Right, depreciation. This is really the aha moment for, I think, almost every new real estate investor.
Okay.
Think of it like this. The IRS lets you write off a piece of the building's value, not the land, just the structure, every single year.
For how long?
For residential property, it's spread over 27.5 years.
Okay, but here's the kicker. The paradox everyone needs to get.
Go on.
You're taking this write-off even while the property itself is very likely going up in actual market value.
Precisely. That's the key. It's what we call a non-cash deduction.
Meaning
You didn't actually spend any cash that year for this specific deduction, but it creates this phantom expense on your tax return.
And that phantom expense directly offsets your real rental income.
Exactly. So let's say your property brings in $15,000 in actual profit, but you claim maybe $10,000 in depreciation that year.
Your taxable income is suddenly only $5,000.
Bingo. It's like an immediate ongoing subsidy baked right into your investment.
Oh, no.
A huge advantage.
Wow. Okay, so step one. Shield income with an expense you didn't actually pay out of pocket. Got it. But running a property does cost real money, maintenance, insurance.
Oh, yeah, absolutely.
Which brings us to the second big benefit, operational deductions. These are the real world costs, right?
Exactly. This part is more straightforward, maybe less magic, but its cumulative impact is enormous. Real estate lets you deduct pretty much every legitimate cost tied to operating that property.
Like what? Give us the big ones.
Okay, think mortgage interest, usually huge in the early years of a loan. Property taxes, obviously. Insurance premiums.
Repairs, keeping the place up.
Necessary repairs, yes.
Yeah.
Maintenance, even things like professional fees if you hire a property manager.
Okay, so let's tie that together. If I have, say, $20,000 in gross rent coming in,
Right.
and after I apply my depreciation, that phantom expense, and all these actual operational deductions, my taxable income could get whittled down to zero, or even show a loss on paper.
Absolutely. That happens all the time. And if it's zero or a loss, you effectively keep that entire $20,000 cash flow shielded from income tax that year.
So my cash in pocket and my taxable income are like two totally different stories.
That is the core mechanism, yes.
Yeah.
It gives you critical breathing room, lets you grow your portfolio much faster than you typically could elsewhere.
Okay, that covers the year-to-year shielding. But what about when you sell? Normally, that's capital gains tax time, right?
Usually, yes. The tax man cometh.
But real estate investors have this this other tool to kind of kick that can down the road, the 1031 exchange.
The 1031. This is probably the ultimate wealth acceleration tool in the playbook.
Oh, so.
So, Section 1031 of the tax code, that's where the name comes from, it basically allows you to sell an investment property
Okay.
and roll the entire proceeds, including all the profit, all the gain you've built up, directly into buying another like-kind investment property.
Without paying capital gains tax at that point.
Exactly. You're not eliminating the tax forever. You're deferring it, pushing it off.
Which means that gain could be tens, even hundreds of thousands of dollars stays working for you instead of going to the IRS right away.
That's the power.
Yeah.
But, and this is crucial, there are very strict rules around this. This isn't casual.
Right, I was going to ask. It sounds great, but what's the catch? Our sources definitely highlight the complexities here.
They do. The big ones are timing. You have to identify potential replacement properties within just 45 days of selling your original one.
Wow, 45 days isn't long.
It's tight. And then you have to complete the purchase of the new property or properties within 180 days total from the initial sale.
And if you miss those deadlines...
Boom. The deferred tax liability becomes due immediately. So it absolutely requires planning, structure, often using a qualified intermediary. Professional help is key.
But if you manage it correctly...
If you manage it correctly, it maximizes the compounding effect of your capital like almost nothing else.
And you could theoretically just keep doing this. Sell 1031, buy bigger, sell 1031.
For decades, yes. Roll those gains over and over, and then potentially when the property passes to heirs.
The step up in basis.
Exactly. The heirs might inherit the property at its current market value, effectively wiping out all those deferred capital gains taxes.
Yeah.
It's a massive generational wealth transfer tool.
Okay, so depreciation deductions, 1031 exchange. That's the big three. Powerful foundation.
Absolutely. But for those listeners now thinking, okay, how do I optimize this even more? We can move beyond the basics.
Into the advanced strategies. For the insanely curious, as you might say.
Yeah. Let's talk about a couple of those. The first one sounds technical, but it's incredibly powerful. Cost segregation studies.
Cost segregation. How's that different from the standard depreciation we already talked about?
Okay, standard depreciation treats the whole building kind of simplistically, right?
Right.
Assumes it all lasts 27.5 years.
Right.
A cost segregation study gets way more granular. You bring in engineers, basically, to analyze the components of the building.
Components like?
Like the carpeting, the interior finishes, maybe specific plumbing or electrical systems, landscaping, site improvements.
Yeah.
Stuff that clearly doesn't last 27.5 years.
Okay, so they break it down.
They break it down and reclassify those specific components into much shorter depreciation schedules, maybe 5, 7, or 15 years. Instead of 27.5.
So instead of spreading the deductions out slowly over almost 3 decades.
You pull massive amounts of those deductions forward, front-loading them into the first few years you own the property.
Generating potentially huge paper losses right away.
Exactly. It accelerates depreciation.
Yeah.
It's fantastic for new acquisitions, especially if you need big write-offs immediately to offset other passive income. It's like turbocharging your deductions.
Okay, that's definitely advanced. Now, what about the investor who's really hands-on? Not just hiring a manager, but, doing the work themselves.
Right, the active manager. This unlocks another potential layer of benefits.
How so?
Well, if you spend enough time and meet certain criteria to qualify as a real estate professional in the eyes of the IRS, or even if you just materially participate in the activity,
Oh, okay.
you might get to treat your real estate losses differently. Remember those paper losses from depreciation we talked about?
Yeah, the phantom losses.
Normally, passive losses can only offset passive income. But if you qualify as active...
Wait, let me guess. You can use those real estate losses to offset other kinds of income, like my regular job income.
Potentially, yes. That's the huge advantage. You could potentially use those paper losses from your rental portfolio to directly reduce your taxable income from your salary, or maybe other business income.
Wow. That turns your rental property into a tax shelter for your entire income picture, potentially.
It can be a massive strategic benefit that most purely passive investors just don't have access to. Requires meeting specific tests, of course, but very powerful.
Okay, and one last quick one on structure. We often see investors using an LLC, a limited liability company. What's the tax angle there?
Well, the primary reason is usually asset protection, separating your personal assets from business liabilities. That's crucial.
Right, makes sense.
But from a tax perspective, an LLC or similar pass-through entities offers flexibility. Income and losses typically just flow through to the owner's personal returns.
So it simplifies things.
It can simplify tracking things, especially managing those passive versus active loss classifications we just discussed. And it makes handling multiple partners or multiple properties under one umbrella structure much cleaner. It's about organization and flexibility as much as direct tax savings.
Got it. Okay, so we've laid out this impressive toolkit for real estate. Let's zoom out again. Why? Why does the tax code have this, well, bias towards property? And how does it really compare side by side with other common investments?
It's a great question. And understanding the why helps. Fundamentally, the government wants people to do certain things.
Like we said earlier, incentivize behavior.
Exactly. They want private investment in physical infrastructure. They want construction jobs, maintenance jobs. They want more housing supply. These tax benefits are essentially the government's way of saying, hey, do this and we'll make it financially attractive for you. They're underwriting that activity.
Okay, so it's intentional policy. Now, contrast that with, say, stocks.
Right. Stocks are much simpler, tax-wise, but generally less favorable. You buy shares, hope they go up. Any dividends you get along the way.
Taxable every year.
Every single year. Typically, there's qualified dividends or ordinary income, depending.
So even if I'm reinvesting those dividends automatically, trying to compound my growth?
You're paying tax on money you never actually saw in your bank account. It reduces your reinvestment amount right off the bat, slows down compounding.
And when I eventually sell the stock?
Capital gains tax on the profit. Pretty straightforward. There's no ongoing deduction mechanism like depreciation while you hold it, and no 1031 equivalent way to defer that final tax bill when you sell and reinvest.
Much simpler, but also much less tax efficient during the holding period and at exit, potentially.
Generally, yes.
Okay.
Now look at bonds or just cash in a savings account.
Okay.
Even less favorable, usually. The interest income you earn from most bonds or basic savings.
Taxed as ordinary income, right? At my highest rate.
Typically, yes. Hit at your highest marginal tax rate every year. You often get pretty minimal returns to begin with, and then those returns are fully exposed to tax.
Ouch. Minimal return, maximum tax exposure.
Pretty much. So when you put it all together, real estate offers this unique package.
Let's summarize that package.
You get ongoing tax advantages during the holding period through depreciation and operational deductions, shielding your cash flow.
Check.
You get the potential for significant appreciation, just like stocks.
Check.
And you get this powerful mechanism, 1031 exchange, to defer taxes on that appreciation when you sell and reinvest.
It really is a comprehensive set of advantages, isn't it?
It really is. Nothing else quite matches that combination.
Okay, theory is great, but this is where it needs to hit home for the listener. Let's make it real, a practical comparison.
Love it. Let's do a hypothetical.
All right. Imagine two investors. Let's call them Investor A and Investor B. Both started 5 years ago with, say, $200,000.
You're $200K each 5 years ago.
And let's say both did pretty well market-wise. They each generated a gross profit of $100,000 over those 5 years on their initial investment. Similar performance on paper.
Got it. $100K gross profit each. Investor B puts their money passively into a stock portfolio.
Right. So Investor B, over the 5 years, they've been paying taxes annually on any dividends they received. Let's factor that in.
Okay. Some tax drag along the way.
Now, Investor B decides to sell their whole portfolio. They realize that $100,000 capital gain. What happens?
Well, depending on their overall income, that gain gets taxed. Federal capital gains rates are, 15% or 20% for most people, plus maybe state taxes.
Let's be conservative. Say 18% total tax on the gain.
Okay, 18% of $100,000 is $18,000. Plus, they already pay taxes on dividends each year. So out of that $100,000 gross profit, they might walk away with maybe $80,000, $82,000 actually in their pocket to reinvest or spend.
Okay, so a significant chunk goes to taxes immediately upon selling. Now, Investor A, same starting capital, same $100,000 gross profit over 5 years, but from a rental property or maybe a small portfolio.
All right. Now, what's different for Investor A?
Well, crucially, over those 5 years, they've been deducting operational expenses.
Mortgage interest, taxes, insurance, repairs.
And, most importantly, taking that annual depreciation deduction.
The phantom expense.
Exactly. So maybe over those 5 years, those total deductions significantly reduce their taxable income from the property. Let's say their cumulative taxable income was only $30,000, even though the cash flow and appreciation totaled $100.
Right. So instead of being taxed incrementally or fully on the $100 profit like Investor B, Investor A has already legally shielded $70,000 of that profit from income tax along the way, thanks to those deductions.
Huge difference already. But now Investor A decides to sell too. What can they do?
Here comes the 1031 exchange.
Right. So Investor B pays their $18,000 or more tax bill and has maybe $82,000 of profit left to reinvest.
Correct.
Investor A executes a 1031 exchange properly. They roll the entire $100,000 gain, plus their original $200K capital, into a new, maybe bigger or better investment property.
Zero capital gains tax paid at that moment. They are immediately reinvesting the government's share, effectively, using pre-tax dollars to grow their base.
So investor A keeps their entire $100K profit working for them, compounding into the next deal, while investor B just lost nearly 20% of their profit to taxes.
That's the fundamental difference in net outcome, purely because of the tax treatment. The net capital investor A has working for them is dramatically higher. It just accelerates everything.
It really does change the entire equation. You're not just focused on gross returns, you're actively managing your tax liability to maximize net returns.
Precisely. It's strategic.
Okay, wrapping this up, Glenn.
So to summarize for everyone listening,
Mm-hmm.
these tax advantages, depreciation, deductions, the 1031 exchange, they aren't just, nice little side perks.
No, they seem fundamental.
They are fundamental drivers of why real estate, over the long haul, often outperforms other asset classes on an after-tax basis. It's about sheltering income, deducting real costs, and deferring taxes strategically. It solidifies real estate's place as a uniquely powerful wealth-building machine.
Incredibly powerful stuff. But we have to say this, and it's important.
Absolutely. Disclaimer time.
Tax law is complex, it changes, it varies by location. What works for one person might not work for you.
Please consult a qualified tax professional, ideally one who really specializes in real estate investment.
Yes. Get advice tailored to your specific financial situation and your jurisdiction. Think of this deep dive as a framework for understanding the potential, not as specific financial advice.
Well said. But here's the final thought we want to leave you with. Mull over.
Okay.
This combination of benefits, depreciation, deductions, deferral whirl, it basically means the tax code is actively designed to reward you for buying assets and holding them, especially assets that provide housing or support infrastructure.
Rewarding acquisition and continuous investment.
Right. So if you're evaluating investments and you're not factoring in this unique ability in real estate to take a non-cash paper loss on an asset that's actually generating real income and potentially appreciating,
You're leaving a major tool on the table.
you're arguably missing the single biggest lever for tax-advantaged wealth preservation available to most investors. Think about that power, the power of the phantom expense as you plan your next moves.